It's 1:30 p.m. in Lagos, same time in London, and we're bringing you markets, analysis, and insights on Business Incorporated here on Channels Television. And here's what's coming up. IMF backs phased rollout of new taxes by governments in sub-Saharan Africa. The Central Bank of Seychelles maintains monetary policy rates at 2% in fourth quarter. And Egypt launches digital platform for connecting subsea cable systems. Hello and welcome to the program again. I'm Will Ibang. Let's kick off with the markets. So we're starting with major equities in Africa, where it was trading with mostly negative sentiments at intraday. We see Nigeria's NGX down 0.34%. We're seeing Egypt, South Africa, however, marginally up 0.05%. So we'll see now, that's what right there on the screen, 0.05%. Nigeria's down 0.34%. Let's see what Egypt did at intraday. 0.89% at intraday, really massive drop for that equity. And now Kenya also closing Tuesday in the red. Now let's go over to the Middle East. Let's flip there and see what they did at intraday. Middle East also mostly negative at intraday. We're seeing the Abu Dhabi index down 0.01%. Dubai down almost 1/3%. And now we see Saudi, however, was trading up more than 1.35%. Now Qatari index down more than 0.5%. Now the EU's Digital Commissioner Thierry Breton told Apple CEO Tim Cook on Tuesday that the iPhone maker needs to open up its products to competitors to comply with the bloc's new rules targeting tech giants. Joining us with more is Chimpoda Chimbelu in Berlin. Chip, so how do these new tech rules affect tech giants like Apple?
Thanks for having me, Will. The new rules are part of the Digital Markets Act, which targets big tech firms. So we're speaking of the likes of Apple, Microsoft, Facebook owner Meta, Amazon, and ByteDance, which owns TikTok. The rule regulates how tech behemoths do business in the EU. The bloc's Digital Commissioner Thierry Breton said that Apple's iPhone users need to be able to benefit from a range of providers when using the devices. And he also said that he had a, quote, constructive discussion on Apple's compliance plan, end quote. The talks were, of course, linked to the Digital Markets Act, which aims to create an environment where one player doesn't become too dominant in the EU. The new rule includes a ban on combining data collected from different services belonging to the same company. So, for instance, Facebook, Instagram, and WhatsApp won't be allowed to share data despite being owned by the same companies. Now, companies will have until early March 2024 to comply.
So we're seeing data sharing restrictions coming out of there, but what impact can we expect from it in Europe and beyond?
Well, critics say that while the Digital Services Act could increase, Digital Markets Act rather, could increase competition, it could hinder innovation. Companies may be less keen to develop systems that complement existing products and services if they fear that they will have to keep them open to competitors as well. Apple is yet to comment on the talks between the EU's Digital Commissioner and its CEO Tim Cook on Tuesday, but the tech giant has made a statement on the Digital Markets Act in the past. It says that it is concerned about the privacy and data security the regulation poses for its users. And of course, for Apple, that may very well have to do with the idea that allowing data to exist in one ecosystem, and an ecosystem that it owns, allows it to protect user data and privacy better than, say, if the information was moved between services. The ban on data collection has already affected Meta's decision to launch Threads, a new social media platform here in Europe. Well, it's not just in Europe, it's around the world, but it hasn't been launched here in Europe. And of course, Threads was launched in early July, but it is still unavailable in Europe for users. The owner of Instagram and Facebook wants more clarity on data collection from the block. So, of course, many will be watching how this turns out. Everyone, of course, will be watching to see whether the EU can take on big tech with this and other measures, and what happens with Apple and Meta could very well help other companies who may have to make similar decisions in the future. And for European users, it will be about not being left out.
Not being left out, we don't want to be left behind. But what are investors focused on in the markets today?
Well, European markets are trading lower today, and after, of course, most of them having closed in the red on Tuesday, investors are still fixated on the risk that U.S. interest rates will remain high for a longer period. Now, of course, that's expected to hurt economic growth. And here in Germany, traders will be watching the shares of the country's biggest car maker, Volkswagen. It has said it will be suspending production of 2 electric vehicle models during the first half of October at 2 sites in 2 eastern German cities due to weak demand. Markets will also be keeping an eye on consumer confidence from Germany and France. And the French government will be unveiling its budget for next year today as well. So they'll be watching that.
Thanks so much, Chip, for that update. Chip on that, Chimbelu, right there from Berlin, Deutsche Welle's correspondent, reporting live for us. Thank you so much. And now we go to the UK, where it's still the controversy of the untapped oil fields, which have been approved by regulators. We've seen that protesters, activists have been against this. We're going to be talking to Juliana about this. We talked about it earlier this morning, but it's still an issue, and we need to, talk about it. Juliana, this doesn't seem to show UK's appetite for the zero carbon drive and that target of meeting 2030 or is it 2050 goals that they have?
You're absolutely right. It's 2050 net zero goals, Will. And the reason why we're still talking about it is because I think we're going to be talking about it for a long time. In fact, there are already emergency protests, quote unquote, taking place now by a campaign group called Fossil Free London outside of the Department of Energy Security and Net Zero. Expect similar protests by organisations such as Just Stop Oil, who we've spoken to on Channel's Business Global several times, as well as some of the other big campaign groups. In fact, we have had lots of response, not just from Green Party members in the Palace of Westminster, but also Conservatives, one describing the government's decision to give the green light to oil drilling in Shetland as complicit in climate crime and morally disturbing. And now the reason why this is a big issue is because we know that oil and gas is no longer a business story. It is now certainly a geopolitical story. And this began in February last year when the Kremlin invaded Ukraine. Particularly if you were in Europe, lots of governments did feel as if they needed to become more energy secure because they didn't want to rely on dictatorships like what we've been seeing coming from Putin. That's one of the reasons why the government are saying, although we haven't heard from them officially on record, that they've given the green light because they do want to make sure they can lower bills. And if they are generating their own oil and gas, it will be easy. The flip side of that is that we know that even if 300 million barrels are able to be come out of this new oil field, only 8% of that is likely to remain in the UK. Similar to what the issues are in Nigeria, we do not have a solid enough refinery. So therefore, the majority of this oil and gas is going to be exported to mainland Europe, and then it will be exported back into the UK in products that we can use, such as petrol and diesel. And we haven't even touched on the fact that this is going to emit several hundreds of tons worth of CO2 emissions. We are in a climate emergency. We hosted COP26 just a couple of years ago, and there were several pledges that the British government, this Conservative government, have put in place, and they're not sticking to the pledges. Just a couple of weeks ago, Prime Minister Rishi Sunak pushed back the date of the ban of petrol and diesel cars. That was supposed to come in 2030. He's pushed it back to 2035. So several issues here. It is likely to face a legal challenge because it's just so big. It's such a huge swathe of land in the North Sea. And it does remain that the future of the North Sea is on a political knife edge. We know that we've got a general election coming up in the UK any moment now. And the Labour government, the Labour opposition party, led by Sir Keir Starmer, have said that they will not be renewing any oil and gas licences there. So, yeah, major talking point at intraday in London today, Will.
I do like how you captured that the future of the North Sea is on the political knife edge is quite interesting. I think the drive for revenue is bigger than the drive for net zero at the moment. Everyone's looking for money, Juliana. And now we're just looking away at something quite interesting. UKs has approved the first drug consumption room, £2.3 million. That facility is supposed to allow users to take illegal substances under medical supervision. Can you tell us more about that, Juliana?
Yeah, it's a really controversial story, actually, another controversial story that we're talking about. But as you said, considering the eye-watering sum it is going to cost the Scottish government to put this facility up and running, it has garnered plenty of news interest. I think any of our viewers watching from the UK will know that Scotland has been battling with illegal drug use for several decades. In fact, drug-related deaths in Scotland are absolutely at the highest in Europe. They have a massive issue with people injecting themselves, and this has led to a HIV outbreak in Glasgow, which is a popular city in Scotland. And this is one of the reasons why over the past few years, MPs, NHS workers and experts working within the field have been mulling over whether or not they should open some sort of facility which would be medically supervised to allow drug users to take their drugs without fear of prosecution. And of course, depending on, the moral, where you stand on the moral ruler in this life will depend on how you will view this story. It has actually been given the green light by Parliament. We know that the Scottish Government is devolved, so they actually govern themselves, but there are certain issues they do need permission by Westminster. It does seem at this stage that the Prime Minister has given it the green light, but of course there are so many moral issues here for the staff. Are the staff going to be safe? For the individuals that are using the drugs, the fact that they're going to be given an open door and a very nice room to be able to kill themselves is quite frightening, actually. But according to the experts, they say there is overwhelming international evidence that safer drug consumption facilities can improve the health, well-being and recovery of users. So apparently they're doing this because they think it is going to be safer. But then, of course, if you're a business, you've got a healthy business, or there are public schools around where this facility is going to be in the east of Glasgow, I'm sure you will be having other doubts. So, yeah, really shocking story, actually, that the UK is going to be given the green light to the first drug consumption room, costing £2.3 million.
So at the time where the UK is looking for money, revenue, thinking about spending that much money on a consumption room, I think it needs a rethink. Don't you think, Juliana? Thank you so much, Juliana, for that update.
Controversial, yes.
Really, really quite controversial. We'll keep an eye on it and see if it eventually works out. Yeah. Thank you so much, Juliana, for sharing this updates on Business Incorporated. And now we move to the U.S., where stock futures traded higher on Wednesday following Tuesday's losses. Dow Jones Industrial Average futures rose by 0.32%. Futures linked to the S&P 500 climbed 0.42%, while NASDAQ 100 futures added 0.4%. Shares of Costco fell 2.5% in after-hours trading, despite beating analyst expectations on the top and bottom lines for its fiscal fourth quarter earnings. But let's hear more about that from yesterday's close with our correspondent, Maria Bird.
The U.S. stock market had another challenging day on Tuesday, as the Dow Jones was down by 1.2%, the S&P 500 slipped at 1.5%, and the heavy-tech NASDAQ took a nosedive of 1.6%. This is all indicating that interest rates will not decrease anytime in the near future. It's also a sign that the economy could be looking at a bit of a recession potentially. It is also clear that investors are watching to see what will happen in the coming days, as the budget deal for the federal government has not yet been brokered, and the end of the fiscal year happens September the 30th. If the budget does not come to a close and there is no deal that is brokered, there could be a sign that the U.S. government could close as of September 30th until a deal is brokered. This all will have an impact on the U.S. stock market.
Thanks, Maria. Next, a look at the investment landscape in Africa. That conversation in a moment. Stay tuned. This is Business Incorporated. Thanks for staying with us. Now, investors in Africa continue to bear the brunt of sticky inflation, and we've also seen that side by side with depreciation of local currencies and foreign exchange pressures, not to say the least. Now, the net effect of the continued slowdown in the global economy comes with a heavier impact on the private capital equity or activities in Africa. Folake Elias Adeboale, partner with Udo Doma and Bello Sage, joins us virtually to unpack this and provide more insights. Good afternoon, Folake. It's good to have you on the program. We've seen.
Thank you very much.
Okay, we've seen the first
I enjoy
half.
your show. I'm delighted to be here.
Great. We've seen the first half of 2023 has been described as a very lackluster. From your perspective as a private equity, venture capital and mergers acquisition business advisor on Nigerian and cross-border deals, which key dynamics, which key drivers have had the greatest impact in shaping and driving current investment and business activity in Nigeria?
Thanks again for having me, Will. I'm delighted to be here. I very much enjoy this show. Let me begin by saying that Nigeria and other African jurisdictions will always be fertile ground for business and investment activity. That's my firm belief. No matter what the short to medium term challenges that we are facing or the steps that we're going to have to navigate and take to facilitate and optimize the business environment to sustain our capacity to attract investment and funds, capital funds from debt. I think encouraged in saying that because industry analysts for private capital, for instance, there's an AFCA report that very encouragingly reports that many limited partners, the global financial investors, the direct finance institutions, continue to consider Nigeria attractive within a 5-year horizon for investment, and this is even more so than emerging markets. In addition, they are still committed to committing private capital over the next 2 years to the continent, notwithstanding all these challenges that we've discussed. So what is sustaining this investor interest, you might ask? And I think it's a shared commercial opportunity that Nigeria and other African jurisdictions present. You have the abundant resources, you have the demographic advantages of the huge population, a young and fast-growing population workforce, over 55% of which are of working age. You have fast-growing, underserved consumer markets. You have the infrastructure deficit, which I see as presenting a huge opportunity. We're talking energy, we're talking technology, communications, food, and energy access. And then there's, of course, our unbeatable entrepreneurial spirit. In terms of why, notwithstanding all these fantastic factors, we've seen a sharp decline in FDI. The National Bureau of Statistics reported a drop between Q4 2022 from $84 million to $48 million in Q1 of 2023, which is sharp. Last year was actually quite encouraging, but things seem to have taken a bit of a nosedive. And that I think, is the result of various factors, not all of which are homegrown or domestic. It's a combination of domestic and global factors. I mean, globally, the macroeconomic headwinds have also not been amazing. A lot of our supporters, our investors are also caught up with sort of their attention is a little bit diverted by addressing their own in-country macroeconomic issues.
Falake, I want to know, you've mentioned the headwinds, macroeconomic headwinds are one of the major issues we've had, but where are the investment? Where are the opportunities? Which sectors are attracting the strongest investment interest in volume and deal size? Because we're seeing that we recorded about a 44% decrease in deals and volumes and 54% decrease when compared to the half year 2022. The first half of 2022 has seen a decline in this areas.
So I think that going with the macroeconomic headwinds, the COVID resilient sectors, as I'd like to call them, like the tech-enabled businesses, you've got healthcare and life sciences, financials are always strongest. You have got agriculture also, and manufacturing and the consumer goods sectors that continue to attract investor interest. They have continued to do so. Deal volumes, mostly financial sectors, the financial services sector leading the fray. In terms of deal value, we're seeing smaller deals being done as investors. The nature of the deals, for instance, in Nigeria, have interestingly been driven by the venture capital sector. That and the macroeconomics and investor perceptions of a heightened risk environment as a result of those macroeconomic headwinds have meant that both investment deals and lending have been sort of smaller sized. Last year, they were very, very high. They were almost 626, I think, according to AFCA, reported deals done in the continent. This year, that has dipped. There has been, I think that discrepancy is due to the same stories that are being told, not just in Nigeria, but across the continent, about depressed GDP rates, high inflation that is driving down purchasing power, high interest that is stifling the ability of consumers and businesses to borrow. Those sorts of issues, and especially you mentioned in your question, the FX volatility and unstable currencies, I think, have sort of exacerbated those challenges. Because what do the FX volatility issues mean? It means that businesses that are import dependent, perhaps they get goods and services that are essential for their operations. There's less certainty about their ability to predict, their ability to pay for those goods and services. Investors are worried about their ability to repatriate capital, being dividends or on disinvestment.
Okay.
Lenders are worried about the ability of borrowers in Nigeria and elsewhere in the continent to repay loans.
Okay, Falake, I know you have a lot to unpack there, but just very, very quickly, could you just tell us the trends to watch, the investment outlook very quickly because we're running out of time?
I think the investment outlook is fairly positive. We have a new CBN governor finally confirmed by the Senate yesterday with his 5 deputies. I think maintaining consistency and effectiveness in policy implementation will be crucial, in addition to addressing the FX shortages, stabilizing the naira, taming inflation, taming interest, and especially engaging investors. Those will be the keys, I think, to ensuring that, if not in the immediate short term, in the medium to long term, investor confidence remains and increases.
Thank you so much, Falake Elias Adeboale, partner Udo Doma and Bello Sage, joining us on Business Incorporated and sharing your insights. Thank you so much for joining us.
Thank you, Will. Thank you.
Now we move on to other stories where the International Monetary Fund, the IMF, has recommended a staggered implementation of new tax measures by governments in sub-Saharan Africa, including Kenya, amid public backlash. The multilateral lender says the sustainability of new policies is dependent on the government's ability to win over public opinion. The IMF suggests delaying difficult fiscal reforms until macroeconomic conditions are favorable and compensatory measures are in place. Now, the Board of Central Bank of Seychelles is maintaining a relaxed monetary policy rate of 2% for the last 3 months of the year. The first Deputy Governor of CBS, Brian Commentant, told the journalists that the board took the decision based on developments within the economy of Seychelles, as well as what is happening globally. He outlined that unless there's a drastic change in analytic results, the monetary policy will be maintained at 2% for the fourth quarter of the year. And now we go to Egypt, where Telecom Egypt's integrated telecom operator has launched its WeConnect ecosystem, providing access to Egypt's extensive subsea cable infrastructure. WeConnect's digital platform enables users to click to order cross-connectivity between the 14 subsea cable systems landing in Egypt's 10 cable stations, linked via the 10 terrestrial routes spanning the country. WeConnect users will easily manage their commercial agreements through the online platform to enjoy accelerated access to the growing number of subsea cable systems with greater agility, adaptability, diversity, and resilience. And that's it on Business Incorporated. Thanks for watching. I'm Will Ibang. I'll see you tomorrow.